Okay, so you should be able to see my desktop now. I'm hoping that you can. If you can't, do let me know. I'm assuming everyone can see my desktop, and then I will go from there. So this webinar presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This webinar has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, they're not available to US residents, and that's because of regulatory reasons. Okay, guys, so you can all see, you can all hear, that's all great. Let's get going. The first thing I'm going to show you, oh, sorry, I've got a problem with my charts, bear with. Now, great. Okay, so the first thing I'm going to show you is this chart. So this is an hourly chart for cable, which I drew these lines on yesterday. Oh, sorry, for euro dollar. My apologies. And it was on the back of that week of the expected PMI data. Some of you may have seen it. And we were looking at this 136.20 level as being a real key level of resistance, certainly in the near term. And indeed it was. We did back away from there. However, today we have pushed above it. So it was always going to go one way or the other. Interesting enough, it didn't go on the side of the fundamentals. So it didn't move higher, it didn't move lower on the back of that weaker German IFO data earlier today. Instead, it's been kind of propelled higher, if you like, by some weakness in cable, which is helping euro sterling to recover. That's recovery in euro sterling is then filtering through to euro dollar. So that's kind of impacts that's the reason for this movement here. So as you can see, we've burst above this mini triangle, and you can also see we are now back above the zero line on the MACD. So this time yesterday it was a different picture. We wrote that we thought that there was a good chance that we'd hit that resistance and back off it. Indeed we did, but just not for that long. So we didn't get a clear break. So where are we going to next? Well, that all depends. As I said, you probably know yourselves, guys, right? We're trading in quite tight ranges. We could get back to this 136.40 level. We did rebuff it earlier. That's your next immediate level of resistance. Then we're looking here at something a bit more significant, actually. 136.70 is the 200-day moving average. Obviously, that's going to be a critical level. If we clear that, then that would be quite a bullish development for euro for sure. But I do think 136.70. If we I think 136.40 could halt the upside. Likewise, 136.70. If not, now we're just putting together our quarterly outlook. So for the third quarter, can you believe it? And I was looking at my kind of US dollar section and what I've written in it, and it's mainly a fundamental outlook. There is a lot of technical stuff included in it, but I don't write that, someone else does. And I wrote from my perspective, from a fundamental perspective, we could see further dollar weakness at the start of this quarter before the dollar continues to rally into the end of the year. And that could really, play out in things like euro and everything else. Is there no sound? Guys, I'm assuming you can hear me. You could hear me earlier. Okay, there is sound. Good. Great. So maybe Ray, just sort out your maybe just adjust your volume. Okay, great. There is sound. So when I was looking at my piece, as I said, the problem, or one of the things to point out, is that yes, we could, certainly from a fundamental standpoint, it supports dollar weakness, which could then support something like euro dollar. Certainly getting up to that 200-day moving average, which comes in 136.70. So that's a big level. Just watch it. As I said, 136.40, 136.70. So the next kind of 50 to 60 pips are going to be quite significant for the single currency in our view. Now, cable took a bit of a tumble earlier today. Let me just as you can see, we're just back above 170 actually. We had fallen, I'll put it onto a daily chart, we had fallen very, very sharply. That was purely at 10 o'clock at the back of those Carney comments, and a couple of other people from the Bank of England. Every quarter they testified to Parliament, and anyway, they decided, they didn't really drift from their message, but we're in a market environment now whereby we're relying on every single comment from a central banker, and sometimes they can say the same thing but just in a slightly different tone or a different order, and the market immediately changes their mind or gets panicked that what they said before didn't mean anything. So we still think that cable is looking good. Certainly from this is just a mini pullback. It looks very steep in this kind of hourly chart, but it's not really in the big picture of things. It really isn't. If we look at it year to date, as you can see, that's a really nice uptrend still in place, and this is just a very normal pullback. 170 was always going to be a bit of a struggle, particularly when we didn't. Let me just leave that there. Look at it even from a 5-year level. We're just waiting to get to this. In fact, if I change the chart, there's, the high is 170.63, which we got to on the 19th of June. We didn't stay above there. We didn't stay above that 170.5 level, which would have been kind of slightly more constructive going into this week. Hence why we're seeing probably that bit of profit taking, a little bit of nervousness around this level. But if I do even, stretch this chart out even more. Oh, not like that. Don't worry, guys. I'll bring it back. That was my fault. If I stretch the chart out even more and I go back to the last time we were at 170, which was kind of 2005 level or 2005 time frame in cable, as you can see, from 170 to 190 pretty much, we just completely flew higher. There wasn't too much in the way of resistance. There wasn't too much holding us back. And so that would, the market does look, charts, technical analysis looks at previous price action. That price action from 2005 there will be known to a lot of people, and so they will be aware of it. They will be aware that in the past 170 to 190 hasn't had too much resistance on the upside, so they'll probably take their time around this level because they don't know if the market wants to push it up to these once you get to 190, well then hey, you're back at parity levels really. That's a big deal. That has an effect on everybody. I could certainly weigh on inflation even more. So that's when central bankers can come out and maybe try to talk down the pound. Maybe if that was what the Bank of England would try to do today, they didn't do it very explicitly. But for now, we're in consolidation pattern. We don't think it's anything too serious. We think that the rally could still extend, or has got some more fuel in it. And that decisive break, we have broken it. The pullbacks are very, very shallow. In fact, if I just go back, say over the last 20 days, since we've been above this kind of 170 level, pullbacks have been very, very shallow. I mean, pretty much since the middle of June now, we've continued to stay where we are. If we were to get back below 169.5 in the short term, that could see a deeper pullback, maybe down to this 168 level, maybe even to the lows of the month so far, which come in at 166.99. But we really don't. We really think that the uptrend is still there. And certainly on a day like today, yes, central bank comments are going to have an impact on it, but they're not going to change the ultimate direction. It's just going to be short-term impacts, we think. So as you can see there, with cable still looking very, very strong. Now we've also heard this morning, from Japan. So the Japanese Prime Minister has been talking to Parliament over there, extolling his latest arrow, if you like. You remember he had the third arrow, 3 arrows. Well, growth, reform of the labour market, etc. That was the third arrow, and that's what he's talking about now. So as you can see, that's had zero impact whatsoever. Look at that almost looks like kind of an alligator's beak, if you like. It looks like an alligator, right? This chart pattern with kind of its long kind of nose and then just this slithering body, because it hasn't been moving it very far. It's really, really narrow, these ranges. We're stuck right now between the 200-day, which comes in at 101.67, and the 50 to 100-day, which come in at 102.08. I mean, boring is not even the beginning of the word. Does not even describe in adequate terms how annoying it's been to trade dollar yen. That doesn't necessarily mean that this volatility will last forever. We know volatility doesn't stay this low forever. If I can just even show you the VIX, I know the VIX is for equity markets, not for not for currency markets. However, I will take the liberty to show you the VIX when looking at dollar yen, purely because it has such an impact on, purely because dollar yen has, you know, fairly close links to equity markets. As you can see here, we've fallen to a record low at 10.34. We've bounced back a little bit now, but we're still below that 11 handle. You know, it felt like only kind of, you know, the start of the, such a short time ago that we lost the 12 handle and everyone was going crazy about it. Well, now we've even extended further to the downside. So that's, you know, something else to think about there. But as you can see here, you know, incredibly tight range. We do have some key data though. Tomorrow we get that GDP release out of the second reading of, or third reading, sorry, of GDP out of the US, and that's expected to have another downturn, a revision lower. We also, of course, get the we also get the durable goods orders, which is a more timely measure. So that's kind of something to worth watching. But certainly in terms of themes out there right now, you know, volatility, when it's at these extreme low levels, should really support a carry trade environment. And that should benefit currencies such as the Aussie and the Kiwi. And then there's, you know, low yielding currencies. Well, you've got your dollar, you've got your yen, they're your traditionals, even your euro these days. That's out of the G3. And for now, anyway, this, you know, dollar yen is just kind of, you know, stuck in the middle, if you like. This is period of low volatility, very tight ranges, is a result of Fed and Japan and Bank of Japan being both so dovish and so sticking to their kind of dovish policies, as we heard from the Fed last week. If you're going to look for, you know, a real carry trade strategy, probably worth looking at either the Euro, Aussie yen, or your Kiwi yen. And that took a tumble this morning as we kind of try to get back above those annual highs. The highs of the last 12 months come at 96,515, which is a high from the 4th of April. If I just stretch out this chart just a little bit, you can see quite a significant level. If we can get above here, then it could potentially take us back to 100. So, you know, this environment, if things in Iraq can calm down, if the RBA doesn't go crazy, if they sound fairly placated by the pickup in China, and the Bank of Japan stay, you know, fairly consistent with their pledge to keep monetary policy very loose, then we would expect Aussie yen maybe to have actually done better with volatility being this low, but certainly to play catch up. And as I said, if we can get above, what was the high? Let me just go back to my annual chart. If we can get above 96.50, so we're currently trading 95.75, 96.50 is the extreme from 4th of April. If we can get above there, that would be very bullish development that could, as I said, take us all the way to 100. Kiwi yen as well. That's probably even a purer play on the carry trade strategy at the moment, because you've got the Bank of the New Zealand Central Bank raising interest rates. But as you can see, with what's going on with Japan, that's actually causing a little bit of nervousness. So, sorry, with everything going on in Iraq and geopolitical issues, that's causing a bit of nervousness. And maybe the yen isn't the best funding currency, and maybe what's easier is to look at something like Euro Kiwi. That's something else maybe to point out. Euro Kiwi, as you can see, you know, it's fallen to lows of the year so far. 155 is a big, you know, level of support there. If we can cross below that, that could be an incredibly bearish development that could take us pretty much to the lowest ever level since the euro has been incepted. The low from the 31st of August 2012, that came in at 149.67. So we're not that far away from there now. And I think if things carry on the way they are, then there could be fresh record lows for Euro Kiwi. And that's certainly something to watch out for. The other thing to point out, I don't know if those of you follow our research or not, please do anyway, it's on forex.com website. But the CAD has been one of our currencies to watch. If I go back to here, I'm going to draw a few. Looking at using Fibonacci analysis just to look at this. Push this down. Okay, cool. So as you can see, we got through the 200-day moving average. Friday was a big day for the CAD, right? A big move lower in dollar CAD, and that came on the back of stronger than expected Canadian CPI. So we got through the 200-day moving average. We got through key resistance at 108.14 to 15, and then we've actually, you know, we're even below the 50% retracement of the September to March advance in dollar CAD. So, you know, we've made a significant drop back. The next level that's open is this 106.03 level, which is 61.8% retracement of that move. So the 50%, you know, this 107.33 level, we haven't really extended anything on the downside. As I said, today's quite a boring day for the markets, and there isn't, you know, as we wait for maybe some GDP, as we wait for, you know, the last week of the month obviously can sometimes be a bit dull. Then we would, you know, next week's going to be super interesting. Next week on the Thursday anyway, we get the NFP release, etc., etc. This is all, you know, the market is very much turning quite hawkish, or is expecting some hawkish sentiment coming out of the Bank of Canada. The Bank of Canada next meet on the 16th of July. So even if the Bank of Canada aren't actually as hawkish as the market expects, there's still kind of, you know, a good 3 weeks until then. So there's a lot of speculation that could come in, and we could get back to those lows from December, you know, back to the lowest levels of the year, around about that 106 level between now and then. So, you know, we still think the CAD looks attractive, and dollar CAD could come under sustained pressure as we've seen here. Just this is a daily chart, just looking at an RSI. We are in oversold territory. We are below 30 in the daily RSI, and that can suggest just a little bit of a pullback. In fact, if I go to our hourly chart, as you can see, we are pulling back a tiny bit, but we do think that anything up towards kind of 107.5 will just be used to sell into and will be faded. A bit like with those cable moves, right? Those cable dips, they may be faded going forward. So, you know, this is certainly our view on dollar CAD. We think it still looks quite good. There is a, you know, as I said, well, central bankers are still the main theme that's worth watching. Now, obviously, what's going on in Iraq and oil prices, that's the big theme. And if we just look at Aussie today, hourly chart again, so very, very short-term chart, we have come off our highs, backed away from those 94.40 levels. And that isn't because all of a sudden the market doesn't care that China's doing well again. It's largely because, you know, this is just a bit of noise, really, this decline in the Aussie, in our view, and comes on the back of that slight softening in commodity prices. So it's just a bit of positioning. We had a big sharp move higher overnight on Sunday, and that was on the back of what happened with China. So just looking here at our Aussie data. This is our Aussie chart annual. As you can see here, we're now kind of looking at that 194.80, those highs from early April. They look to be very much on the cards. And then above there, you're kind of looking at the October highs here, which came in just below 98. So we're having a nice steady move higher. The downside seems to be capped at 93.24. Held us very good support earlier. And as I said, like, you know, in this environment of low volatility, your Aussie, you know, the higher risk end of the FX spectrum, the Aussie, the CAD, the Kiwi, they should be doing well. And I'd even lump the pound in there as well, because remember, the pound used to be, well, up until fairly recently, considered a commodity currency and would move with things like the CAD, the Aussie, etc. It's always been a lot more volatile than something like, say, the euro, and even to some extent the US dollar. So guys, does anyone have anything they'd like me to talk about? I'm going to just take another quick look, sorry guys, I'm going to take a quick look just at the FTSE there. Yesterday we saw, you know, this could be a big week for the FTSE, and the reason why I say that is that yesterday we saw home builders come under a lot of pressure, and that was because we had a credit lending survey from the Bank of England, which came out and said that the change this chart, which came out and said that the you know, banks are going to make it harder to give mortgages, which could potentially dampen demand for housing. Now, coming off a very, very you know, incredibly high bar, because we know that housing activity, etc., is very strong in the UK. So it's just kind of retreating slightly, but that did knock the FTSE. Came back to its 50-day moving average, which comes in at 6782. As I mentioned earlier, you know, the S&P 500 trading in such tiny ranges that you know, that is actually kind of falling through the you know, the rest of the, you know, global markets, and hence, you know, we saw that decline yesterday. Now, on Thursday, we get the FPC, which is the Bank of England Financial Policy Committee. Mark Carney chairs it, and he'll be talking. He may announce some macro prudential measures at 10:30 London time to try and stem house price, housing price bubble, basically. Again, that could hurt house builders. It could also hurt maybe lenders as well. As if there's reduced mortgage lending, they've got less chance of making, or one less chance to make money. And again, that's important because the banking sector in the FTSE is significant, right? I'll just tell you exactly its weighting. It hurts everything. If there's macro-prudential measures that could have a knock-on effect on things like, DIY stores, et cetera. So you do have to watch out for that. That's on Thursday. As I said, if we get below this 50-day moving average, a daily close below 6782 would be very bearish. It could take us down to the 6720 area, maybe even 6673 area, which is the 200-day moving average, also the yellow line on this chart. So financials in the index is now over 21%, and then we've got home builders are kind of a subsector of consumer, and that comes in roughly about 10%. So there's a fairly large third of the index at least that could be impacted by these measures. So Pan, you're saying, does your book explain these relationships? It does certainly go in some way to explain how the relationships between central banks and central banks and how they can impact markets, how the market reacts to them. On that note, though, guys, I am doing the next edition of the Dummies book, Currency Trading for Dummies. So if you've got anything that you'd like to share, or you'd like me to include in the book, or certainly have maybe include in the book, please let me know. And please either send me something now, or I'll be back on here next week. You can do it then. Pan, you're saying, shouldn't yen weaken for the same reasons Aussie, Kiwi and sterling should go up? Yen's a different case, though. I don't think so. The reason why, because, the reason why I think that it shouldn't at the same time is because you've got a ton of monetary stimulus coming from Japan, and that is for there. So Pan, you can't get through John Murphy's book. Well, that's good, because mine is a lot shorter, so hopefully you will enjoy it, and please do let me know your thoughts. The yen is a funny one, Pan. When we get weak economic data out of Japan, that can cause the yen to rally. Yen's obviously a safe haven, so it rallies on concerns, say like what we've had with Iraq, which is one of the reasons why dollar yen hasn't been able to make any headway. But then on the other hand, you also have this huge Bank of Japan stimulus program, which is going to limit yen strength in our view. It has to. So it's a little bit of a funnier, let's put it this way, less clear cut. Now, Paul, you have very patiently waited for me to look at gold. Just the last thing then on the FTSE, do watch out for further declines. That's our view. That could happen. Obviously, if the FPC on Thursday aren't as bearish as expected, we could turn right around and we could move back higher. There are market risks that are impacting the UK index. It's still moving roughly in line with global indices, but there are going to be some domestic fundamentals which could take precedence, certainly towards the end of this month, towards Thursday. So let's look at gold. Gold had a very good week last week. Had some, as concerns were raised about what was going on in Iraq, we saw that shoot higher back through those moving averages there. As you can see, the 250 and 100-day moving averages got back above that 1300 level. But we've really struggled to extend on the upside. Now, we are higher today, but 1335, the high from mid-April, now comes into view. And then obviously, between there and 1400, there really isn't much in the way. But we still think that, if we see, the Iraq crisis just managed to simmer down a little bit, then in the short term anyway, we could see, the gold price at least just maybe retreat back to that 50, 200-day moving average where they've converged, which comes in around about 1285. So we would watch out for that. Obviously, I'm not saying that gold is going to tumble from here. I just think that on the back of, it may not be necessary. We've got deflation pressure, certainly in the Eurozone, certainly throughout Europe. The one thing where gold might react, though, is actually if we see, yes, it's a safe haven, but it's also, it does also react to economic data. So yesterday, for example, it eked out a very, very small gain on the back of some better than expected US economic data, which maybe suggests that the Federal Reserve is just being too cautious. They're being too loose for too long. The other thing I would point out as well, is that we could end up seeing the PCE deflator. So that's a preferred measure of inflation that's watched by the Fed. Or the preferred inflation measure looked at by the Fed. That is going to be released later this week. So that's going to be a key release now, because the Fed last week sounded like they were willing to just look through rising inflation. They didn't seem too concerned about it. Yellen called it noise. I think she's wrong. I think they're going to have to start looking at inflation. And the PCE deflator is expected to rise to 1.8 from 1.6%. Anything stronger than that, we could see gold jump above that 1335 level, getting back, attempting anyway to get back to these March levels, because there could be concerns about an inflation breakout. We've been talking about it for a while. There've been price pressures certainly building for some time, and if they explode, then that's a great opportunity. A lot of people potentially may want to buy gold on the back of that. So I hope that helped you, Paul, if that was useful. Pan, yes, those intermarket relationships, sure. I always try to give a bit of intermarket relationships or intermarket analysis when I talk about this. The trouble is, at the moment, obviously, when John Murphy wrote his first book, non-conventional monetary policy wasn't the norm. And so it's really interesting now because what we have is a situation whereby the markets are finding it quite difficult to interpret central banks. So it's a really interesting thing to look at for sure. And it's something that we will certainly continue to look at going forward. So, guys, I think I'm going to leave it there. It seems like you've all done really well. Thanks for repeating my book. That's really nice of you. As I said, if you want me to look at anything in particular for the new Dummies book, Currency Trading for Dummies, and that won't be out for a while yet, though. But if there's something that you think maybe it's going to be following a model, maybe it's about low volatility, something like that, then maybe you could. Maybe you can let me know. Maybe it's about how to use social media. If there's anything, it can be, what Dummies books are like. They tend to be as irreverent as anything. Please join this and send us something, or please send us a message on Twitter. Our handle is @ForexCom. I'll just send it here. Thanks, Paul, for getting the book. My book is called Kathleen Brooks on Forex. That would be great if you could read that. Just send you our Twitter handle now, and then you can certainly join next week and give me some suggestions what you'd like to include in my new book, the Currency Trading for Dummies. Okay, everyone, thank you so much for joining. Always really great, and good luck trading this week. And please do join us next week for more. Okay, bye, everybody.